Hey everyone, first off, thank you so much for coming to Digital Hollywood. This is, as you guys know, one of the premier conferences around regarding anything to do with media technology, entertainment convergence. My name is Ash Kumra. I'm honored to be your moderator here. I am a serial entrepreneur primarily in the digital media space. My latest venture is it's actually not in the brochure because it just launched 3 weeks ago. It's a digital content network called Tradecraft, which is promoting and distributing content that empowers the millennial generation to achieve their dreams and goals. And aside from that, I'm a best-selling author on entrepreneurship, and I've done some public speaking. But most importantly, what matters right now is I have the honor of helping you get answers from these very smart individuals. So this panel is really about what's happening with the whole crowdfunding world. Crowdfunding's been around, but it seems to be getting more and more interesting, innovative, whether it's equity-based crowdfunding, whether it's more platforms, whether it's, films that are getting social proof and then actually getting their whole budgets created, to even the tech entrepreneurship using crowdfunding to get funding or be on shows like Shark Tank. It's insane. Crowdfunding is like literally in my opinion, the biggest capital infusion that's hit our economy, because any person now, especially with some of these upcoming rules, which our panelists will talk about, can allow anyone to fund any dream. That's a pretty bold statement, but think about it. A local shop in Wisconsin could get literally $100,000 from local friends and family. A church down the street, which is competing with other churches but needs community funds, can now use crowdfunding tools to get amplified and do with the great work that they're doing. And I can go on and on and on. But before I do that, I want to ask the panelists to introduce themselves very briefly, and then we're going to dive into a couple questions. Some of the questions I already shared with them, and then I want to do the best I can to get audience Q&A. So if you can write in advance your questions, that would be really helpful, and I'll do my best to answer all of them. So why don't we get started with you, Ron, and everyone else, please introduce yourself and what you do. Thanks.
Thank you. Well, thanks. I'm Ron Miller, and I'm the CEO of Start Engine Crowdfunding. We're a platform that allows both accredited and unaccredited investors to invest in growth companies. And our mission basically is to help entrepreneurs achieve their dreams.
Great.
David Albert Pierce, managing partner of Pierce Law Group. We're an entertainment law firm that does both transactional and litigation, and predominantly representing independent film and television producers as well as new media entrepreneurs.
My name is Steve Ma. I'm a partner with the law firm of Burley Sullivan. I'm here with my partner Brian Sullivan, who you'll meet in a second. I focus on securities litigation, including work related to crowdfunding and generally with entertainment, digital media, and technology companies here in Los Angeles.
I'm Brian Sullivan. I'm an entertainment litigator and transactional attorney. I also am an investor in crowdfunder.com and also do many crowdfunding investments over the past several months.
I'm curious, is anyone here considering to do a crowdfunding, whether it's reward or equity based? Okay, you got two money guys here, so definitely hound them after this panel. Sorry, guys. Ron, I'm kind of curious because I've known you for a few years now, and you're like seriously one of the biggest crowdfunding components. Like, you know how Superman has the big S? He has like a CF under his chest, literally. I mean, he's a huge proponent. You've seen the trends happening, and we talked over email about equity versus rewards, i.e. Indiegogo and Kickstarter. What's your thoughts on the whole world?
Well, I think right now is probably the most dynamic point in this industry, and I think that what we're already seeing has been a huge change in offering opportunity to people like you guys that want to fund great projects. First off, prior to last June, since the Securities Act of 1933, an unaccredited investor, that's your average everyday common person, could not invest in a privately held company unless it was listed on a stock exchange, right? So that basically meant that only rich people, and well-connected rich people at that, got a shot to invest in whether it was a media project or whether it was a Facebook, a Google, a Dropbox, a PayPal, any of those things. It was only for the wealthy, well-connected. Along comes the Jobs Act, which actually was passed in 2012, but the rules didn't come around till just this past June, when finally on June 19th was the very first day that an unaccredited investor That's someone who is earning less than $1 million, or I'm sorry, has a net worth of less than $1 million, or earns less than $300,000, married, 250 single, can now invest in one of your projects. And so that was probably the greatest advancement for capital formation in film and television in a generation, right there. Now, that said, there haven't been a lot of projects just yet. I think there are some coming. We're in dialogue with several media and entertainment companies about bringing their products onto our platform to raise capital, and we're very excited about that. But also there's a new rule set that's going to be coming out called Title III. It's a little bit different than the one that we're operating under currently. And that one will basically also allow for unaccredited investors to invest in startups, but the cap on that is at $1 million. So you can't raise more than $1 million under the set of rules that is likely to come out, I'd say, in the next 60 days.
Next 60 days?
I would say next 60
wow.
days.
Do you know how historic that is, everyone? That example I gave about the local shop or the local church or that early stage venture talking to people that are unaccredited investors legally, that's going to change the game. Brian, I'm curious. I mean, it's kind of cool that you both wear a legal hat and you're an investor in crowdfunder and crowdfunding projects. How is this going to change everything from a cap table legalese standpoint, this new rule that's happening, or will happen, I'm sorry?
Well, I mean, before you do your crowdfunding, you better be prepared to deal with your cap tables.
Okay.
Because even before crowdfunding came up, I always was brought in to clean up cap tables.
Explain that, please.
Who owns your company, basically. It's called a capital table. Who's contributed the money to actually start the company, to keep the company operating, depending on what series it comes at. A lot of times some companies used friends and family to raise money, and they just started the company and everybody right at the beginning threw in. Other times they use angel investors to do it. And a lot of times it's you have a very smart technical person who doesn't know anything about business, and he gets his neighbor to put in $50,000 and he gives him 50% of the company. Well, now you got a guy who owns 50% of a company, and he doesn't have to give up that money because they, of course, use LegalZoom to do their operating agreement or their shareholders agreement.
What a jab at the online legal world.
Hey, I used to be a partner of Bob Shapiro, so it's okay.
All right.
But if you're really out there to build a company and raise a company with investors, you have to be smart about how you're organizing your company from the outset. And even dealing with some of the companies that have come to Crowdfunder, one of the things that they do is make sure that the company is organized in a way that they can actually take on investors and meet the promises that they're making in the offerings.
Okay, I want to dive a little further, though, about this cap table. First off, does everyone understand what a cap table is now? 'Cause my question's around that. Okay, cool. Is there a limit to the amount of investors that, or unaccredited investors or accredited, that can be on a cap table if they want to do this new rule that Ron is saying is going to happen in 60 days?
I don't believe there's a limit to the number of people that you can take. It's just that it's just how much you're raising from them.
Okay.
You can only raise up to $1 million under the one set of rules, and then for accredited investors, there's the other set of rules that you can raise a lot more.
Okay.
So you can have as many investors as you have stock issued.
Okay. Well, David, I know you're very knowledgeable in the different types of financing models and stuff like that. Let's use a simple example, okay? Let's say I have a new company and I'm raising $1 million and I want to use this new rule that's happening. What are the different financing options or methods you suggest?
I'm going to stir things up a little bit with two guys side by side who are pro-equity crowdfunding and be the conservative and pessimistic one on the panel.
Okay.
I'm going to suggest you use donor crowdsource financing, which I'm a huge champion of. That is where nobody's expecting a profit. They're getting a hat, they're getting a ticket to the premiere, they're getting the first op to get the DVD, and I don't care how big you are or how well funded you are, everybody should be using donor-based crowdfunding from the very start, because that does a couple things. One, gives you some initial money. I recommend use that for your startup costs to fund for like a private placement offering to do a bigger raise, or if you're a film company to create your LLC or C Corp if in some cases that's what's best to fit. And if you're filming in New York, you want to use a C Corp and not an LLC. And these are things that entertainment lawyers and security lawyers can advise you on, and which you will not get from LegalZoom. And I think it's a because I've seen, I think all of us here, I think the three lawyers on the panel each have horror stories about people that thought they were saving money by using LegalZoom. They've made the horrific choices that are with uneducated choices and have come back to really bite them in their ass. And I think you would probably agree, right?
Yes. Because now you have another lawyer on the panel.
There you go. So the donor base is good. Not only does it raise that initial little segment to organize your company, do a private placement, perhaps make a pay-or-play offer to that star actor, it also creates your list of hardcore fans. And it lists who are these people that are going to be your unpaid publicists across the country. It's also important to know that the only people that are going to give from donor are your friends and family. 20 years ago, if people went door to door, or even 5 years ago, to every neighbor and said, hey, I'm trying to make a film, could you give me $20? Could you give me $1,000? People go, oh my God, this is so pathetic. We feel, look what's happened to this kid fresh out of film school. But that's exactly what you're doing with donor-based financing, but because it's got the internet attached to it, it's hip, it's cool, it's cutting edge, and people are like, wow, this is great. But don't think that there's anybody out there that's just surfing the donor-based crowd site saying, I want to give to them. There has to be a connection. If it's a charity, if it's a niche, you're a fan of Zach Braff, or you're a fan of Adam Carolla's, or you're a fan of Veronica Mars, those are their friends and family. But for you, it's going to be your legitimate friends and family, but it's a nice way to raise this little core amount without looking pathetic going past the hat, which is what you're doing. And you have publicists that now don't forget these people. Through every course of production, you're going to keep in contact with them, let them know what's happening, gives them the buzz, and let them go viral with with promoting the film. So that's why no matter how well funded you are, use donor base because it creates people that are rabid fans and are going to support, and you can never have enough of those.
Let me jump in because I actually, despite being an investor in Crowdfunder, I agree with everything you just said. A lot of people come to me and they talk, oh, well, I'm just going to raise the money by crowdfunding. I'm like, really, what's your plan? And they're like, you just put it up on the platform and money comes in. It's not exactly how it works. You have to work really hard. On the crowdfunding investments that I've done, the CEOs of the company have called me back to talk to me about it. And I wasn't doing $100,000 or $1 million investments. I was doing small dollar investments, 10 to 25,000. And they still took the time to call me. They still take the time to keep up, and they gave me gifts. I invested in a vineyard and got 10 bottles of wine out of it. So you have to do that, and over the long term, it's a great strategy to raise initial money by donor-based and then go do a crowdfunding equity-based, because now you have the capital to pay attorneys, to dot the I's and cross the T's to make sure that you do it right. So when you go out on a crowdfunding platform, you're going to have a successful raise. And Ron, correct me if I'm wrong, we want you to have a successful raise because every failed raise is like a black eye to us. We want you to use our platforms, and we want you to be very successful at it.
And my one concern with equity, and we have a securities lawyer and couple, and then we have a litigator. Oh, I'm sorry, you're not the one guy next to you. Yeah, an entrepreneur. Okay.
Sam is ill.
My one concern, and perhaps they can address my concerns with the equity, is there's still rules. First, it's going to be very expensive for compliance. Maybe there's shortcuts to that, but. Well, because you still have to comply with this Reg A+, and the one rule that you can't get around is you need to disclose all material information that a reasonable, prudent investor would want to know before they invest. And when you're doing a $5 million film and you use the traditional private placement, private friends and family, high net worth individuals who can afford the loss, it's risky enough with those guys who are your friends and family giving investment money to hope that none of them turn sour when their investment fails, because film finance is very high risk. So maybe what I'm saying only applies to the entertainment industry and not as much in other industries. But with the private placement of films, when you now go to an equity-based crowdfunding, where people are expecting a profit, and you don't know who those people are. I mean, right now you can say, I don't want my cousin in on this because he's a jerk. If he doesn't get his money, I know he's going to sue. But when you go to crowdsource financing and everyone can put in $100 and they're all around the country and you don't know where they are, and it's an incredibly high-risk investment like film is, when they don't make their money back, all they need to do is say, you didn't disclose all material information that a reasonable, prudent investor would want to know. And you'll say, well, I'll just give the guy $100 back. That's great, but what if that guy has a cousin who is a class action attorney? And he gets his class action bills. We all been a participant, seen class actions. You get a nickel back because something was wrong with the cell phone thing. But the class action attorney gets millions of dollars in attorney fees. And this is, again, I feel, I'm sandwiched here. But this is my big concern, and maybe they can address the issues here. Love donor-based financing, but at least for high-risk films, I feel much more comfortable with private placement offerings, at least until the dust settles and we've seen how some litigation plays out and what is and isn't required.
So if I could
Please.
just throw a little color on that. So I think, first of all, the reward-based or donor-based crowdfunding is great, but typically that's for lower, I would think of it as sub $100,000 financing, right? So if you need capital to do a project and you think it's less than $100,000, I think I tend to agree that probably reward-based crowdfunding is the place to go. The second step that'll come in place, like I said, within 60 days is the one that'll let you raise up to $1 million. That's called Title III, and that one's, the rule set isn't even out yet. So it's a little bit early to be talking certainly substantively about it, but that's going to be your second phase. And then thirdly is the Reg A+, and that's what Start Engine operates under. That's where you can raise up to $50 million. So if you're thinking about doing something significant, either as a media technology company or a significant budget production, you're probably going to need to go past that million and look at Reg A+. Now, that said, let me explain why I think that reward-based crowdfunding as we know it today is on its way out, okay? Because the paradigm is this, is that if I'm the one with the project, I come to you and I say, great, why don't you put in $100, you put in your 100, I'll give you a t-shirt and I'll get rich, right? And that's exactly what happened. There was a virtual reality company that raised about $2.2 million on Kickstarter, sold the company for $2 billion to Facebook, and the people who backed it got zero, right? So we couldn't have thought about a better advertisement for equity-based crowdfunding because those people got absolutely nothing. The paradigm shift of equity crowdfunding is where you're saying to the market, hey, rather than you put up the money and just a few people getting rich, we're all in this together. I sometimes think about it as serving what I call the wantrepreneur. That's people who want to be what you guys are, meaning they want to be producers, they want to be creatives, they want to be bringing new products and companies into the marketplace, but can't for a lot of legitimate reasons, either because they don't have the skills, the knowledge, the background, perhaps they're tied into a job with overheads, you guys know that drill. But those are the reasons. So here, with equity-based crowdfunding, you're giving them an opportunity to come on that entrepreneurial journey with you. And I think if you look at strong campaigns, and if you look at the campaigns on Start Engine and you watch those videos, what you'll see is not just a description of the company and the product, but you're going to see an invitation. And an invitation to participate really in the rebirth of the American dream and watching people do things together in a meaningful way. And that's where I think the equity side of it shifts the paradigm.
Could you tell us a little about yourself real quick before you...
Sure. My name is Marlon Schulman. I'm the CEO and founder of Horror Equity Fund. It's a company that discovers, develops, accelerates to market, and helps to fund horror-centric projects, mostly films, but we also do some transmedia stuff, live events, etc. I'm also by training an attorney, although not a securities attorney, but I've been involved.
And none of these people work for LegalZoom, as you can obviously see.
Yeah, and I really want to apologize for being a bit late. But I heard the comments from the panel, and it's interesting because it's almost as if you smush them all together, you end up with what Horror Equity Fund is now and what it's going to be. We are a equity-based crowdfunding at its core, an equity-based crowdfunding site as one of its tools. However, using Reg A+, which is the mini IPO path that we're on, we're going to be able to fund in whole or in part horror-centric projects by ourselves. So ultimately, what the company is going to be doing is having 3 tools, basically. We'll be able to go out and find private equity, as one of the other gentlemen just said, through traditional means. We'll also be able to crowd invest, and we manage the campaign, because film directors, why should they be doing a marketing campaign to raise money? That's not their job, that's our job. The third way is we're going to have our own money that we'll be able to either seed the project or pay for it in whole or in part. So we've brought together all of it, and by investing in HEF itself, Horror Equity Fund, we have a situation where we've mitigated the risk across the board. You have a diversified portfolio, and mitigated all the risk across. We're sort of a studio without the risk of overhead and without the risk of production on any given feature. So we've put together all the portions of the new breed of financing and put it into a company. We're in negotiations now with a fabulous Reg A plus company, platform. That might be Ron's, I'm not sure, right? Because they are they're the state of the art.
I have this is all fantastic so far, and I kind of want to jab at LegalZoom for a second, all jokes aside, because the one thing that still comes to my mind when these individuals talk about all these different financing options is, how is this all structurally going to look like? So again, I want to use a really simple example. I'm raising a project, $1 million. Don't even know what it is yet. It's just a new co. I just go blind and I go on one of these, Title 3 is out, and I want to just go out there. Steve, I'm kind of curious, how do you handle the difference between, let's say, an angel or a VC who's maybe putting in 100,000 of that $1 million versus, 100 people that are putting in 1,000 apiece? How does that work legal-wise?
Well, in some ways, there's no difference.
Okay.
And in some ways, there's a lot of difference. So obviously, the biggest difference is an angel, a VC. I mean, these are people that are not only by law, but in practice, know what they're getting into. They're usually accredited investors. They've done all their homework. With unaccredited investors, you are literally pulling people that saw your website and maybe, an astrophysicist, or they may be, a garage mechanic, my dad. And so at the end of the day, if you put in $100, that's $100. And guess what? The fact that your website had something in there that was incorrect, if somebody who was an MBA from Stanford was able to pick it up, but somebody who was a garage mechanic couldn't pick it up, tough. If it was incorrect, it was incorrect. And so there's a risk. So as you're bringing in unaccredited investors, you are pushing the needle as to people who are going to say, hey, I didn't know this. You should have told me this. This is material information that I, as an investor, should have known. And that's when you start getting into areas of gray. And I'm going to pick on my colleague here a little bit. And I don't think being an equity investment or a donor investment, donor crowdfunding versus equity crowdfunding, really makes a difference. At the end of the day, you need to make sure you are running a business and doing it well. I'm not just talking about fraudsters. I'm talking about people who, let's say, have a great product and they can build 10 of them, and then they become the greatest thing since sliced bread, and they say, we want 1 million of them by the end of the year. And there's no way they can build 1 million of these products. And guess what? Then they should tell people, there's no way I can do this. Or they should say, our projections are incorrect. This is going to take 6 months, not 3 months. But the fact that it is a donor platform is not really going to save you from lawsuits or save you from people who are claiming that they were misled. I think the one difference that might exist is that the platform might have a little bit more legal coverage. So, I'm sure most of the folks here are probably entrepreneurs or starting companies, but if you are running Indiegogo, there's probably less of a legal liability than if you were running, a company that did A plus equity crowdfunding, because at that point now, it's not just a donation. You don't have all these crazy disclaimers that say, put your money in at your own risk. There's no way you're going to get the money back. But by the way, if you look at any of these highfalutin, offering circulars that you get for major motion picture films, every single one of them say the same thing. They said the motion picture industry is very dangerous. There's no way in hell you're going to get your money back. Don't even think about giving us your money. But guess what? They get funded all the time because there are people who want to be involved in that business, okay? They want to have dinner with Angelina Jolie at the opening party. That's just the way it works. But, if these are people who know it and they can weigh the risks and get in, it's one thing. But if it's, a retiree in Palm Springs who kind of liked the last Angelina Jolie movie and is going to write a check for $100,000, I mean, it starts to get dangerous. And it was always dangerous because if some huckster tried to pull the wool over somebody's eyes. But now you're on the internet. So it could be some guy sitting in the Cayman Islands writing all this stuff and got some really cool glossies from Getty Images. And so that's what you got to weigh against. And that's why the regulators are being very careful about this. And so I think it's very exciting that Reg A Plus came out. But I think the SEC and the different regulators are kind of watching what happens in the next 12 months before they officially, start tinkering with what the rules are. And I think people like Ron and everybody here is very interested to see what happens with Title III. But it's a work in progress. At the end of the day, this is such a new area. The rules and the practices are still being, flushed out. I think the biggest issue is going to be for cost. Today, in October of 2015, the difference is, instead of spending $1 million plus to have, a traditional IPO, you could probably do a $50 million raise under A plus for, I've seen some numbers where lawyers talk about doing it for like $75,000. That's unbelievable. Okay, $50 million to raise and to be able to do it for less than $100,000. That's a complete game changer, no question about it.
I could sense that there's some questions from the crowd. So before I do that, though, I want to ask each of the panelists here a fireball question. They don't even know I'm going to ask them this. Could you just describe your best crowdfunding campaign that you've been involved with? And why did it work? Because clearly you guys are all here because there was a campaign that moved you, whether it made money or impacted people, whatever it is. I just want to know, what is that campaign that really, that's like you use it all the time when you talk about why you do what you do with crowdfunding.
Well, that's an easy one for me. So we've got a campaign currently up. It's a company called Elio Motors, E-L-I-O, Elio Motors, and it's on the Start Engine platform. We believe it will likely succeed as the most successful crowdfunding campaign of any kind in history worldwide. It currently has close to 39 million of investor indications of interest to purchase shares at about 39 million. There's about 10,400 individual people who have indicated interest in this company. So we're very, very excited about it. In order for them to convert these indications of interest to actual purchase of shares, they have to file for authorization with the SEC. They have filed those forms and they're waiting for approval. We should know in the next 2 to 4 weeks we'll get the approval, and then probably 2 to 4 weeks later we'll know where it ended up. They've asked for authorization for 25 million in shares sold. So they're going to go back out to their 38 or 39 million of reservations and tell them there's only 25 million. I think that'll create some incentive to move it along.
Does this have any correlation with Title III?
No, that is a Regulation A plus raise.
Okay.
Now you also asked, the corollary question was, why is that one successful?
Yeah.
And the answer to that is that, first off, when they came to us, they had a existing community of about 40,000 people who had put reservations on those vehicles, and they also had a pretty significant Facebook community of around 20,000 people. So that certainly helped. And in fact, at that point, I would have told this panel that, look, you really need to have that community in place before you can launch a crowdfunding campaign. And I would have just said, well, that's just required, right? Along comes our next company, which is a company called XTI Aircraft. And these were guys that had the patents for a vertical takeoff and landing private airplane, basically. And these guys, no one even knew the company existed. And the campaign's only been out for about 6 weeks, and so far they have about 11 million of test the water commitments already having been made with zero knowledge, zero community. And what it was done through a very well done and well executed crowdfunding campaign is what I think did it. And I'm happy later to talk about what that is, if you want to get to it. But
thanks.
If I had a novel jet aircraft company or anything else, Ron is awesome. That's the company to use. But I'm telling you, the film industry, there is a tried and true way that works, okay? Movies are either made for over 100 million or they're made for $7.5 million and less, and that's where the profit is. The danger zone is anything, you can go maybe 20 million and below, but that 20 million to 100 million, the studios don't make them anymore. All right, I was a part of John Wick, which was about a $15 million budget. And that used the tried and true method of, well, they didn't have, I don't know whether they did or didn't have crowdsourced financing. I represented one lender. But let's say what you do is you raise $50,000 from friends and family by donor financing. You then use that to have your lawyers, do a, tried and true, old-fashioned private placement Reg D offering for a component of equity. It's 20 million. Let's say you're looking to raise. You try to raise 5 million through equity. So now you got 15 million you still have to pay for. And maybe we use some of that money if it's left over to solidify the option and do some chain of title so you've got a product that you can say you actually control when you do the private placement offering. If crowdsourced financing isn't around, what John Wick had in place at some point is a development or bridge loan that can come in at any time that sort of is a gap financing when either your cash flow, you've got the money at the end of the day, but when you need it, it's not there, or you need someone to take a risk. And I love development and bridge loans, and I use them quite a bit in the film industry. I'll come back and talk a little bit about them in a second. You do your equity financing. Now we got 15 million to raise. We got 5 million in equity, private placement, good old-fashioned Reg D. You get a foreign pre-sale agent who already knows before this movie's even made, Keanu Reeves, action film, lots of death. We're going to do at least, $10 million, even if it stinks throughout the rest of the world. So you do foreign pre-sales. They sell the paper to France, Italy, Germany. They get all these things that say, when we make this film, will you give us 500,000? Will you give us $1 million? They collect all these IOUs. If you make it, we will pay. You have a bank loan lend against that. So maybe you got 10 million in promises. That lends against 7.5 million because some of that paper might be bad paper. Now you try and do the same. In John Wick's case, they hope to do the domestic the same way, but they couldn't get a domestic deal. You film in Louisiana or another place where there's tax credits and tax rebates. Understand the difference. There is a difference. One requires a broker that you're not going to get all the money for your investment. Another, you'll get that full thing back. A rebate's always better than a credit. But you have to figure out when you're going to get that money, and you might have to cash flow that with a development or bridge loan again. In-kind co-productions, you have the post-production company does the work for free in favor of some upend on the profits, and they get a presentation credit. Maybe product placement is thrown in there. And then in the case of John Wick, where you didn't have a domestic distributor, there was essentially a loan guaranteed by a letter of credit by a few high-worth individuals that said, if after 1 year in the distribution cycle, the domestic bank hasn't gotten back 7.5, because you had 7.5 in foreign, you needed 7.5 in the U.S., maybe it was a little less with the product placement and all the other things I mentioned. These high net worth individuals say, we will repay the bank loan. So they're gambling that the domestic is going to be a success, and they'll have enough to pay off the loan, plus they get that, they get a big, rich reward. That's the way that film was done. There are sophisticated in entertainment and financiers that do this day in, day out, and they know anything, that what the budget is, what it's likely to do in the return, and for at least film and television, I would be very, very careful. I'm a lawyer, so it's my job to be careful. Try and follow the tried and true method. When you branch off, you might be taking more risks than you necessarily need to, and there's a reason why that studio's not making that movie. But again, if it's a jet engine, new type of flyer, I'm going to start engine. I'm just concerned because it's high risk, the film industry, and low reward. It's not high risk, high reward. It's low reward, and they are going there to meet Angelina Jolie at the premiere. So, stick with the friends and family and the donor-based financing. That's it.
Thanks. Steve, how about you?
I'm going to answer it slightly differently because there's so many great crowdfunding campaigns out there. I will talk about the one that I hate the most. The one last year that came out that got a lot of publicity was this silly potato salad thing that was on Kickstarter. And if you never heard about it. And so what happened is that there were a couple fraudulent campaigns that were going on, and then Kickstarter and some of the platforms went out of their way. They said, listen, this is not an investment, this is not equity, this is a donation. So if it doesn't work out, I'm sorry, we love you, but you can't sue us. And so some people thought that this was so interesting and ridiculous that they started putting crowdfunding campaigns for potato salad, saying, I'm going to make potato salad, can you please put in $1? And it raised money, and it's just ridiculous. And so when that, and this is, I don't mean to pick on you, but that was a donation-based crowdfunding.
No, it's all right, but they don't want the donation. That's fine.
Right.
They know they're not going to get it.
And I saw that, and I'm going to be frank, I was ticked off when I saw that, because literally this is such an amazing platform. There's a lot of interesting, projects that are out there, and people are looking for an avenue to try and get eyes on their project. I mean, not everybody can have, Neil Young work on their project or Spike Lee or whatever. So they're doing what they need to do to get marketing out there. And this thing, this potato salad thing, is like, it's an internet hit, and it just ticks me off that. And I think it's going to tick off other people too. And I think Ron has a point where I think it's going to have people start going towards equity as opposed to a donor-based platform, because they're going to say, well, what is this? This is a joke. People aren't doing this as a business. They're doing this because they think it's funny. And it's not funny. I mean, these are people who have businesses to run, and there's a great opportunity to take advantage of these new rules that are out there.
I'm going to talk about one that I love and I hate, and that's probably the most famous one is the Veronica Mars one.
Oh, okay.
I love it because I was a fan of the series, but they also had everything that you could possibly want. They had a studio backing it if they raised the money. They had the rights. They had seasoned filmmakers and people in the entertainment industry. They had the cast all locked up, so it was the perfect scenario. The reason I hate it so much is because everybody thinks they can do that, and you can't. I had people come in and they say, oh, we want to do a movie. We want to crowdfund it. It's going to be great. It's going to be a prequel to Aliens. Who are you? Do you know Ridley Scott? Do you have the rights to any of this? Of course, the answer is no, no, and no. So, where are you going to go with any of this?
And they want you to defer the fees.
And of course, because there's going to be a hit movie, so they want to put me on a 5% deal for that one. But again, it's like the same thing. Huge success, but everybody thinks they can do it, and that's not the case. You also had a basis, already a fan base in place to do that, but everybody thinks they can do that. So that's why I love and hate it. I'll talk to what was said before. I did an investment, which I thought, I'll talk from the investor standpoint. When I do a crowdfunding investment, I look for a couple of key things. I look for experience with the people who are operating the company. I like to see a company that is operating and even on a small basis and is looking to expand, and I like to see intellectual property or some sort of trade secrets that is locked up. So if you kind of can't fall into that, I know myself and I know a lot of other investors will just go right by you at that point.
I'm going to touch on two, and they were both actually mentioned as inspiration. The Oculus Rift, which is the virtual reality headset, drove me nuts because it was a $2.1 or $2.2 million crowdfund raise, donation based, and you get the headset and a one-person shooter game. An investment on that was about, I think, $340 some odd dollars, and you got the thing eventually. What they did was they took that $2.1 million, parlayed that, sold equity in it directly to Reg D type people for $19.1 million after that. Then they sold it to Facebook for $2.1 billion. The people did in fact get their one-person shooter, but if you had done the math, a $340 some odd investment would have translated into, if it had been equity, about $43,000 profit. And I thought that was a little unfair. Not unfair because it was exactly what they promised and they got the first-person shooter game and the thing, but I said, well, here's an opportunity. If you build the right mousetrap and you have the right product, you can bring a lot of people in. The other one was Veronica Mars, which drove me crazy. Why somebody would, as rabid a fan as you might have been, why you would support Warner Brothers, a multi-billion-dollar company, to build.
For the record, I did not donate
Okay.
to that.
And then they had the audacity, and this was just happenstance, that the downloads that you were promised, many of them were broken, and it took a number of weeks to get the download of the movie. What I decided to do was to go to a huge affinity group, the horror people throughout the world. I had been a key executive for bringing anime into the country years ago and built a community called Anime Village, Japanese animation. I knew that this decentralized family of fans, of rabid fans who are horror, would, I believe, come to want to donate to a situation where they can own a piece of a horror studio, basically, and or individual horror movies. Horror, specifically for the people out there who don't know, is the single highest return on investment entertainment property consistently. 15 out of the 20 highest ROIs films are horror. And yes, there are many flops, but at the same time, you get the paranormal, you get Saw, you get, they're all flying out of my head right now, Halloween, all the other ones. Oculus is actually in my business plan. Veronica Mars is in my business plan. All those films are in the business plan. And what we've done is we've attracted a tremendous amount of attention from independent films, low budget to micro budget films, not the 15. 15 is a really tough land to live in. I agree that 20 million above or the lower ones are the way to go, but in the middle, very, very tough. Yet we're attracting anything from, our first film came out, it's available on iTunes today, called Starleaf. I commend it to your attention. A $50,000 budget. The trailer for most of the films that you might hear about down there on the panel would cost more than $50,000. It's a beautiful looking film. It's gotten great reviews already. Starleaf. Anyway, so that's what inspired, those are the two that inspired me.
Thank you. Well, thank you all for sharing those examples. Let me jump into some questions. Please.
I have a two-part question, please. My name is Mike Kerman. I'm a writer, producer, and entrepreneur. And my first part of my question is, authors sell books. Stores don't sell books. Amazon doesn't sell books. Authors sell books. Authors have to drive the traffic to their titles, have to drive the crowds in the audience to buy their books. If you don't have a big list or a big platform, what is the likelihood of you being able to attract the crowdfunding raise? That's part A. Part B is, I'd love to know from the success that's on the dais, what is the DNA or the specific step-by-step, even in large chunks of success for crowdfunding? I mean, it's great to hear all these great stories, but if you're solopreneurs or infopreneurs or whatever entrepreneurs we are down here, what are the steps that we need to take, the big chunks, to get to whether it's 10,000 raise or 100,000 raise or a million raise? What are those steps?
So let me delegate this just for the sake of time. Ron, would you mind answering the first question about the DNA part? And
Sure.
then Brian, could you answer the second question about the tranches financing stuff? Yep. Cool.
Okay, so I think the DNA of any successful crowdfunding campaign, whether it's rewards or equity-based or what rules that you're operating under, it's actually the same DNA that creates the success. There's three basic steps. First is creating the message. Second is producing the message. And third is distributing the message, right? So creating the message. When you create a message, you have to think about what is going to excite people, not just with the product. This is the hardest thing that I find with people, with the entrepreneurs, the creatives that want to raise capital. It's not just about the product, but it's also about why people want to go on the journey of becoming that co-producer with you, right? And you have to share that story. That's creating the message. Something that's compelling, something that when people see it, they can't wait to get involved in your project, right? So that's creating the message. And of course, explaining what the product is and its upside, and I think Marlon did a great job of explaining why horror. I mean, I personally just got excited about it in hearing that it's the single most profitable sector in the film business. And I'm watching you nodding your head, and I'm saying, okay, wow, this sounds good. Let's get going here, right? So that's part of it too, the substance, okay? Next thing is producing the message. And that means creating a video, and written content is what it means. The video is just a piece. I get approached by a lot of videographers who say, great, I'll make videos for your people. I say, well, that's great. That's the equivalent of my telling you that I need to get to work every day, and you're saying, hey, I make great steering wheels. And I say, well, great, that's good. I got to have a good steering wheel, have to. But that's not enough. Just the video is one component of it, and it has to be well done, but it's got to carry that message that is intentionally designed to not just carry your brand, your product, your idea into the market, but also to get people really excited about going on that journey with you, right? And then it's the written content. The written content is what actually appears on one of the platforms so that when people read about it or look at it or forward it to their friends, that they're going to get really excited about it. So that's the second step, is producing the message. The third step is distribution. And distribution takes place in three forms. One is traditional media. That's PR, just as you know it. The second is social media. And the third is paid media. And I strongly recommend that you got to think about or get involved with somebody or partner with somebody that really knows how to do it. Otherwise, you end up, sort of looks like the same as that LegalZoom situation where you try to do it yourself and it doesn't quite work out that well. So that's the DNA that I think is in any of the three, reward or any form of equity.
That's a really good answer. Brian?
To discuss the amount it all depends on what your audience is. I mean, if you're already operating and you have, like Veronica Mars, they had a massive audience because they had a devout fan base of a couple million people watched it every week and however many downloaded it. But if you're just in a circle for family and friends, and that's your audience that you're pitching to, then you can't raise $1 million. You can only raise 10, 20, 30, 40, 50,000. So there's no hard and fast rules about how much you should raise. You should create a budget for the project that you're looking for. If you need to do PR for it, find out how much a publicist charges. I just had a friend, he's in his 60s, doesn't know anything about social media, had a book published. He's been a longtime sports writer and created Xena Warrior Princess. So he has some basis, but he doesn't know anything about technology. So he hired a guy and did a social media one. Since he created Xena, he doesn't have to raise money for any of it. But that is something that you got to work into the budget to figure out how much you need to raise. And I would suggest doing, best case scenario and worst case scenario. And then figuring out what your audience is and who you can market it to. Because it's about marketing yourself. You start,
real quick,
like Ron just laid out in the PR ways. You can do traditional PR. Most people can't afford to do that. So most people doing crowdfunding are going to do social media to their network, their friends and family, and then ask their friends and family to do a blast on Facebook or Instagram or whatever it is to get to the next network or Twitter and to keep going to try to gather as many fans as possible.
I represent a lot of traditional authors, and I tell them all the same thing. You don't need a publisher in 2015. You can all self-publish. You can all get on Amazon. The money a publisher's going to keep, probably when all is over and said and done, at least 60%. Probably even more because they have the cost of the book and everything, and they got interest on it. They're just like a studio distributor. You get this small little pittance as the author. So figure out what that take is. Put your self-publish, put it on Amazon, put it on the other places on the net, and that money that would all go to the book publisher, spend every single dime on an awesome publicist and a social media campaign, and figure out how to get that message across so people know your book is around. And you'll wind up way ahead of the game with a traditional book publisher today.
One of the key things I mentioned before and that separates our company from anything else, and I know it only has to do with horror, is that we don't expect an author/movie maker to conduct their own crowdfunding campaign. We manage it for you. We have the database. We have the community that we're building, the Federation of Horror, which is a community that we're building as well. So although you are paying a certain amount to the company to do this, you're not managing it. It's not your time. It's our database, and we're going to bring that benefit to you.
1,000 times cheaper to pay him to raise the money to self-publish than to have a traditional publisher involved.
You're the last question, and then we'll adjourn.
Thanks very much. Thanks very much, the panel. Fantastic. I've crowdfunded a couple of documentaries and consulted on about 5 or 6 others, most of which were successful, but learned more from the ones that were failures. But I'm wondering, what is the advantage of using a platform like Kickstarter and Indiegogo now? A lot of what I'm hearing, a lot of what I experience, you really have to go out and market that on your own once it's out there. They're not doing a lot to help you unless you get some sort of level that they're showing you're trending. So have you worked with any projects that have not used the platform and just said, I'm going to do this for my own website, for my Facebook page, and were they successful, and what would you advise?
Anybody?
I've heard of people trying it on their own. I'm not aware of any that have been tremendously successful. So there's a short answer. It might be a little bit like our LegalZoom analogy, where you can try this at home. But what we do as a platform, it is true that in crowdfunding, basically the responsibility for promoting the campaign is up to the person that's trying to raise the capital. And now while we do help our issuers, so we have a full-time PR company. Yes, we put PR. We've gotten major PR for our issuers. It is the individual issuer's responsibility to promote the raise. Now, we also have a community of around 30,000 registered investors that are on the Start Engine platform, about 14,000 of which have already invested or indicated interest in one of the companies that are there. We certainly make the offering aware to those guys so that at least gets a start. But here's what's important, is that basically we facilitate on a turnkey basis end-to-end to help the entrepreneur succeed in raising the capital. We win when the companies win. We don't charge anything when companies test the waters. We only charge when they begin to actually collect the cash. So we're very much a stakeholder in making sure there's a win here. And in doing that, we help companies with the promotion of the campaign, those 3 steps that I was talking about earlier. We connect you with companies that do that. We know who the good ones are. We connect you with companies that will do the audits. We will connect you with legal talent that actually knows how to get the stuff done with the SEC. And finally, we connect you with back-end people that do everything from manage the digital cap table we were talking about earlier, the escrow, the anti-money laundering. There's a lot of technical requirements, all which are taken care of, allowing the entrepreneur to focus on the raise in their business and allow us to sort of facilitate the back end of the process.
Anyone else want to share about that? Why use a platform versus?
Well, if you're using a platform, especially in the entertainment world, you have somebody that already has an audience, and so you're bringing eyeballs, like Ron said. Eyeballs are coming to the platform one way or the other. There's also a certain air of legitimacy that you have. You're not some guy on television at 2 o'clock in the morning offering a pre-order of something for $5.95, and maybe you'll get it in 6 weeks, and then you have to start making phone calls, etc. It really is important to have your ducks in a row, to tried out some expressions, to have things ready to go. I know that we have not started our Reg A Plus thing, but I have 2 tables worth of dominoes all ready to go to hit it and for everything to fall the right way. So I think platforms are terrific, and I also agree that Kickstarter and Indiegogo, they will be, if they don't shift their emphasis, it'll be relegated to pre-orders and donations and things of that nature. It's not scalable for films or other types of entertainment projects.
And if I could just add in one concluding comment. I know there's a lot of sort of complexity and issues we brought up today, but I'd say at the end of the day, crowdfunding represents the greatest advancement for entrepreneurship in a generation.
Yeah, I agree.
And you have to remember that there are, I think as of about 2 years ago, Kickstarter alone, one platform, 19,000 successful projects were funded, raising close to $750 million a year just from one platform. And so this train has left the station, and it's time. It's time to move projects forward. The inability to form and create capital is probably the biggest inhibitor to you guys bringing great projects and great technologies to the market. And I hope that what you guys will do is to take advantage of it in any form that you happen to feel is a great fit for your particular business and your project, and bring this stuff forward and make it happen. Because increasingly the barrier between those that have great ideas and those that have the ability to execute due to the limitation on capital are being diminished by crowdfunding, and I hope you guys will take advantage of it.
Hey, well, guys, I want to, first off, let's give the panels a round of applause. Fantastic. And we're all going to be here for a little bit. If you want to talk about anything, any questions on crowdfunding, entrepreneurship, whatnot, hopefully they'll all be here for a little while. Thanks.
Hi there.